Shares of DraftKings popped higher at the beginning of the Friday session, but well off the highs of 34.56. After DraftKings surpassed analyst expectations in the second quarter, DraftKings posted a loss of 17 cents per share on revenue of $875 million. Analysts were looking for a loss of 25 cents a share and $764 million in revenue. Now, before we discuss why price went through the weekly sellers level at $29, let's listen in to a video on TMC as they discuss the quarter with the CEO.
CEO Jason Robbins. Jason, thanks for joining us. I want to start with your outlook. You beat, and it seemed like a lot of this was driven by the unit economics, which you described as outstanding. But what is behind your higher outlook for Q3?
I really think it has a lot to do with the culmination of the last several quarters, really the last, several years of effort. So it's a great quarter, but a lot's gone into it. First, the product has dramatically improved year over year. We've also continued to really optimize our marketing. And also, I think we've just done a lot of things to clean up the customer experience, remove friction, and create a really good, smooth experience in UI for our customers. Still a lot of work to be done, but I think all that's culminated in us seeing strong engagement, retention, customer acquisition has been way up on the year with a decrease in CAC. So just a lot of really good tailwinds when you look at the metrics of the business right now.
And in terms of the metrics of the business, I think it's interesting the way you've been rolling out. Obviously you have different strength in different sports. It seems like baseball was a sign of strength. But also you have these new potential markets. I'm curious what your outlook is for access to new markets and also potentially new bettors. Are you more focused on gaining market share or in building the addressable market?
Well, I think right now at the stage we're at, it has to be both. Obviously, the TAM, the total addressable market, is still growing rapidly. New states are coming on, new customers are coming, even in our oldest states, which, remember, even our oldest states are only about 4 or 5 years old. It's not that old. We're still seeing robust customer acquisition and revenue growth. So I think it's a combination of both. Still a lot of TAM, I think, to be developed. And I think doing that in the right way, getting more states opened up, all very important. But also we feel like we've really been able to compete for share by improving our product and honing our customer experience over the past year, and we have a lot more exciting things. The team is laser focused now because, remember, upcoming, Q2 is great, but this is the most important time of year coming up for us. So, everybody is locked in and ready to go for this fall.
Of course, we have the NFL season starting just around the corner. One of the things I've been watching as I cover the streaming space so closely is how the rise of streaming, and now we're hearing even more about ESPN going direct to consumer. We just heard from Warner Brothers Discovery CEO David Zaslav talking about his interest in potentially doing more streaming of sports. That means more fragmentation. And I'm wondering if you're at all worried about fragmentation making it harder for people to find the sports that they want to watch and therefore want to bet on. Is it making it a sort of another challenge to get people to bet on sports?
I don't think so. I think that people who are, avid sports fans, they're going to follow where the sports go. But you're right that fragmentation will have some effect on the media market. I actually think it's probably a positive effect because more competition for ad dollars is a good thing. But I definitely think that customers who are engaged and into sports, they're going to go find ways to watch sports they want. I also think that, this stuff sort of naturally takes care of itself. The most important thing to the leagues and to the players long term is that they have an audience and that audience has access to their content. So, I know from just my experience talking to the various sports leagues that that's a key factor they consider, and they're very careful to make sure that, the partners that they're working with are not only able to pay the money that they need, but also able to generate and at least maintain the audience. And, I think that they understand that very well. So I'm confident that audience will be able to be there and will be able to find the sports that they want to watch.
What's the potential upside from all of this streaming? Will we have a day where I'll be able to turn on my Apple TV, watch a game, and bet through my Apple TV? Will there be integration into streaming?
That's certainly a possibility. With mobile devices, it's so easy for you to do it in your handheld. So it's almost like for a lot of customers, is it that much different? But I absolutely think the integration and the ability to have a betting experience that's tailored to the streaming customer, it's just much more significant because unlike a linear channel, you can create all sorts of different streams. You can create streams specifically tailored for bettors. You can create streams in different languages. So there's a lot of things that you can do that just open up the audience more, make it a more engaging experience for the people who are playing fantasy sports or betting on those games, and really customize and tailor and personalize what the audience is looking for.
All right, so getting back to the weekly chart, you can see we had a weekly sellers level at $29. You had a drop in price, a couple of basing candles, and then a leg out, drop in price all the way down to roughly $11. Price on the way up did form buy zones. You had a daily bias level at 1450. You had another one at 2150. And here's the reason why. So for the better half of 2 months, 8 weeks, price was just hovering around this weekly sellers level until price shot up on a strong extended range green candle to eventually close above the upper end of the zone. I'm not sure why price gapped up and had a strong move higher. Must have been some type of news catalyst. Nevertheless, let's drill down to the. Before we do that, I want to point out this level here. You had a drop in price on basic candle and a drop. So this is a. Let's move this up. This is going to be the new weekly sellers level. We're going to call that $37. Now, something to note, if we look at the leg out, volume is not the greatest, but it is above average. So that's a legit level to consider as another price target from the current price of $31.74. Let's drill down to the weekly chart, daily chart. And as you can see, we had a gap up higher, but then price sold off. Yeah, it'll be interesting to see what happens over the coming weeks. Obviously, you're in an uptrend, and potentially you could have seen that this was just a pullback, as someone knew the earnings were going to be decent before price shot higher. Again, all your moving averages are pointing up, so the chart suggests price is going to continue to move higher. It might move higher and lower in ebbs and flows, but your next target is at the $37 level. Thanks for watching. Subscribe. Please like the video.